Truth seekers, could the 2008 financial crisis happen again? Stick till the end of the video to find out. In 2008, the first of the once-in-a-lifetime economic calamities of most of our lifetimes engulfed the country and the world. Now, just over a decade later, we get to experience the second. In the spring of 2008, Wall Street's fifth-largest investment bank collapsed, loaded with junk mortgages and other questionable assets. Bear Stearns was hardly a linchpin institution, yet the Bush administration decided to bail out the firm's creditors. The two politically powerful and recklessly run government-sponsored enterprises, Fannie Mae and Freddie Mac, which were bulked up with subprime mortgages, teetered during that summer. Washington came to their rescue. Then Washington let Lehman Brothers, a far larger and more important institution than Bear Stearns, fail. No more bailouts, was the message. And then the first money market ever created, having become overly aggressive, was hit with losses. A run on money market funds, which had over $2 trillion in assets, ensued. Simultaneously, AIG, the world's largest commercial insurance company, needed a huge infusion of emergency cash. Panic erupted as everyone clutched cash in desperation. Washington reversed course again, granting federal guarantees for money market funds and bailouts for selected banks. AIG and Citigroup were, in effect, nationalized. The Bush administration was obstinately oblivious to the perniciousness of this decree. Finally, in early March 2009, thanks to the efforts of a handful of enlightened individuals, the House of Representatives held a hearing that made it sharply clear that this edict had to go. Regulators got the message and effectively defanged the destructive rule that was threatening the very existence of our banking system. That put an abrupt end to the terrible bear market that had battered equity averages by almost 60%. The subsequent bull market has gone on to this day. The head of the major financial regulatory agencies appointed by Trump all have strong ties to Wall Street and have stated their commitment to reversing the regulations implemented since the financial crisis. Among them are Treasury Secretary Steve Mnuchin, who was a hedge fund manager and partner at Goldman Sachs, SEC Chairman Jay Clayton, a former partner at Sullivan & Cromwell, specializing in mergers and acquisitions, and controller of the currency Joseph Otting, who was vice chairman at US Bank. Powell was a managing director at Bankers Trust when the bank was caught up in a derivatives trading scandal, and partner at the Carlyle Group Investment Company. As the government rushes to aid the economy, how that's done, who benefits, and who is left behind matter. So far, the signs are ominous. How well the country responded to the 2008 global financial crisis is still subject to debate. After the crisis peaked in September 2008 and the government intervened with various bailout programs, the financial system and corporate America stabilized. Corporate profits were rising again by the second half of 2009. Almost everything else is in dispute. Did the efforts to save the economy do enough to help average Americans? The global financial crisis of 2008 threw millions out of their home and jobs. The Obama administration designed programs to help people stay in their homes, but they were spectacular disappointments. The median household income stayed below where it was in 2007, and in 2000, until 2016. But at least the Great Recession taught the country two broad brush lessons: bailouts should help working Americans, and the financial system should be made more resilient to shocks. Or so we thought. Still, in the early stages of the pandemic economic fallout, we are already replicating many of the same mistakes from 2008. True, the two crises have striking differences. The previous global panic arose thanks to the financial system's lending recklessness and, in some cases, deception and fraud. Here, something akin to a natural disaster has swallowed lives and the economy with it. But the rescue and recovery imperatives are the same. As the government rushes to aid the economy, how that's done, who benefits, and who is left behind matter. So far, the signs are ominous. The bailout is going to repeat a lot of mistakes of the 2008 interventions, said Amanda Fisher, the policy director for the Washington Center for Equitable Growth, a left-leaning economic think tank. After those rescue efforts, corporate America's profits bounced back quickly, but most working people have not seen their conditions improve. Just as the two crises are not the same, neither are the rescues. This time around, help for working Americans is more of a priority. The marquee provision of the multi-trillion-dollar CARES Act, passed by Congress late last month, is the expansion of unemployment insurance and direct payments to citizens. If those go out quickly, and there are already concerns about that will be helpful. But the package also bolsters corporations, mainly through $500 billion from taxpayers. In the 2008 version of this aid, the Troubled Asset Relief Program, banks were asked politely to expand lending with their taxpayer largesse. They did not, and the same thing could happen again. Restrictions attached to the money going to small and medium-sized businesses are spelled out clearly. Funds should be used to help companies retain more of their workforce. Companies cannot pay out dividends or buy back stock. Companies must honor collective bargaining agreements and stay neutral during union drives. They can't outsource or ship jobs offshore. But the enforcement mechanism is weak. The Treasury Secretary shall endeavor to implement these aspects of the program, the law says. The companies need to produce a good faith certification that they have adhered to these conditions. The real problems lie with the aid to large corporations. Most of the $454 billion earmarked for this program will go to them. Another portion of loans and grants are earmarked for airlines and Boeing. Though the law contains some language for these giant corporations to prevent buybacks, preclude dividends, and set limits on executive compensation, no employee protections are spelled out. And the executive compensation limits are set at last year's levels, not exactly the stuff of great sacrifice during a spectacular economic cratering. For every condition, there's a loophole. The Treasury Secretary can waive any of the big business conditions if, as the law states, it is necessary to protect the interests of the federal government. What that means will be up to Steve Mnuchin, a reliable friend of Wall Street and big business. The Treasury Department did not respond to a request seeking comment. What's more, the key aspect of the lending program is that the Federal Reserve will lend to corporations to borrow on top of the government's contribution, up to 10 times. Anything from the Fed that isn't a direct loan to a company is not subject to the restrictions attached to the Treasury money. In addition to the squishy language that gives flexibility to Mnuchin, the oversight lacks teeth. The law does set up a congressional oversight panel to monitor the program, but this provision, too, replicates a problem with the 2008 bailout. Last time around, Congress created the Congressional Oversight Panel, but it didn't have much in the way of power beyond that of the bully pulpit. Elizabeth Warren, then a private citizen who served as the chair, turned that into a powerful cudgel to point out the lack of banker accountability and the failure to help homeowners. But the panel's work did not substantially affect the course of the bailout or correct its flaws. Another hallmark of the 2008 bailout was needlessly complex programs with the wrong incentive structures. As ProPublica chronicled in story after story, the government programs to help people get mortgage relief were plagued by ongoing chaos, lax enforcement, and outright failure. The biggest banks could not handle the demand and did not have the proper financial incentives to actually give people loan relief. In addition to repeating failures in how we send out the lifeboats and to whom, we also failed during the calm before the inevitable storm. After the financial crisis, the government started conducting the annual stress tests of the largest financial institutions, subjecting them to pretend crashes to gauge whether they could withstand crises. But it's turning out that the stress tests were inadequate. They did not predict anything close to what's happening now. Take just one portion of the stress tests. The severely adverse scenario for the Fed's 2020 stress tests had unemployment rising from 3.5%, where it was in early 2020, to a peak of 10% a year and a half later. Now that rise is going to happen in a matter of weeks, and will probably be much direr. The Fed suffered a similar failure of imagination. Its stress tests were similar every year. Unemployment went up, but over several quarters. Economic growth went down but then went up. Some regulators called for testing a much wider range of scenarios. Pandemics are not unknown. Nor is war. How about crippling cyber attacks or assaults on the electrical grid that shut down growth for a month? The Fed doesn't subject banks to any of those scenarios. Nor does the central bank test against more modest, but still unusual, recessions, such as one where growth and unemployment drop but then do not rebound for a long time. "We are very, very ready for a standard deep recession," said a person who helped design the stress tests and who had urged his colleagues to be more imaginative. This person and sources quoted below were granted anonymity because they were not authorized to speak on the record. We are not ready for much of anything else. Now, anything else is upon us. And just as in the acute phase of the 2008 crisis, the government doesn't understand the urgency of making the banking system stronger. The US government has not mandated a suspension of dividends, stock buybacks, or bonuses for all financial institutions, despite former Federal Reserve officials calling for such a move. Europe is already implementing a variety of these measures. Making banks keep capital right now is smart because a true financial crisis, if not upon us right now, is likely to come, especially the longer the economic downturn lasts. In still another echo of 2008, regulators spent the period before this crisis easing up on the reforms implemented after the last crisis. Led by Randall Quarles, a Trump appointee on the Federal Reserve Board, regulators loosened numerous bank rules in the past couple of years. They also allowed banks and financial players to load up vulnerable companies with risky debt. In recent weeks, amid capital market wobbles, bank regulators have eased a variety of regulations even more. Relaxing financial regulations in the past few years did not cause this economic crisis. And so far, large American banks are not suffering nearly as bad as they did in 2008. But these rollbacks could make the system more vulnerable in the coming months than it should be. The design of the rescue package has left those who watched and studied 2008 deeply frustrated. I do not have a good explanation of how we continue to fumble this. I was thinking when this started, at least we have 2008 to guide us to not make the same mistakes, said a Hill staffer familiar with the CARES Act. This will paper over bank balance sheet problems, help tech valuations and boost leveraged loans. In 3 months, I think the stock market will look good. But the vast majority of workers will be worse off. The law will amplify inequality and the power of large corporations over labor and the workforce, and they won't be able to recover for a generation. Every administration includes some members of this revolving door, but the Trump administration has a disproportionate number of top regulators from the financial industry and Wall Street. The current state of the US economy appears strong, with a low unemployment rate hovering around 4% and continued GDP growth that exceeded 4% for the 4th time in the past 7 years. Indeed, the recovery it has made since the depths of the Great Recession has been nothing short of miraculous. However, brewing below the surface is the undoing of the prudent regulatory and monetary policies of the last decade. If this continues, it spells a recipe for another financial crisis that will bring back the days of high inflation and high unemployment not seen in more than 30 years. Those who do not learn history are doomed to repeat it.